In 2021, a staggering $643 billion flowed into a highly specific, exceptionally risky asset class, eclipsing the gross domestic product of entire nations. Yet, the vast majority of the companies receiving this influx of capital were statistically destined to fail. This is not a glitch in the global financial architecture. It is the very engine of it. Why would the smartest money in the world intentionally underwrite a system where failure is the most probable outcome? The answer lies in a financial mechanism that has completely rewired the modern economy, transforming garage-bound ideas into sovereign-level monopolies. Venture capital is often romanticized as a benevolent patron of technological progress, the lifeblood of Silicon Valley startups. But beneath the mythology of visionary founders and disruptive innovation lies a ruthless, mathematically precise incentive structure. Analyzing this ecosystem requires stripping away the narrative of the lone genius and examining the raw mechanics of risk allocation. The venture model does not merely fund innovation. It dictates the exact shape, speed, and scale that innovation must take. To understand this architecture, one must first grasp the power law distribution of returns. Traditional finance operates on a normal distribution, where an investor expects a portfolio of steady, moderate gains. Venture capital operates in an entirely different mathematical universe. In a typical fund, 80% of the investments will either go bankrupt or barely return their initial capital. The entire financial viability of the fund hinges on the remaining 20%, and often on a single company that achieves exponential growth, delivering returns of 10,000% or more. This extreme asymmetry fundamentally alters the definition of risk. For a venture capitalist, the greatest danger is not losing money on a failed startup. The ultimate catastrophe is missing out on the one anomalous success that defines a decade. Therefore, the capital deployed demands hypergrowth. A company cannot simply aim to be profitable and sustainable. It must be engineered to conquer a global market, to become one of the tech giants that dictate modern commerce, or it is considered a failure by the strict mathematics of the fund. This mathematical imperative creates a unique, high-pressure alignment between the financier and the entrepreneur. When capital is injected into a nascent enterprise, it comes with a ticking clock and an implicit mandate to scale at all costs. Founders are incentivized to prioritize aggressive market capture over immediate profitability, burning through millions of dollars to acquire users, subsidize products, and crush competition. The venture model effectively weaponizes capital as a competitive moat. The true systemic impact of this model first became glaringly visible at the turn of the millennium. The dot-com bubble was not merely a speculative frenzy driven by irrational retail investors. It was the first mass-scale stress test of venture capital mechanics applied to the emerging infrastructure of the Internet. Billions of dollars were poured into unproven business models with the singular goal of achieving dominant market share before the capital ran out. When that market euphoria inevitably collapsed, the resulting crater wiped out trillions in paper wealth. Yet the underlying strategy was validated in the ashes. The few companies that survived the carnage, the ones that had successfully utilized venture funding to build insurmountable network effects, emerged as the undisputed monopolists of the digital age. The systemic lesson learned was not one of caution, but of absolute conviction in the winner-take-all dynamic. As the ecosystem matured, the mechanics of funding became increasingly sophisticated. The creation of a company transformed from a purely industrial endeavor into a highly structured process of financial engineering. Successive rounds of funding act as a series of valuation milestones. Each round is designed to inflate the paper value of the enterprise, allowing early investors to mark up their portfolios while diluting the founder's equity, a calculated trade-off for the fuel needed to sustain hypergrowth. This relentless pursuit of scale birthed a new economic entity known as the unicorn. A private startup valued at over $1.0 billion was once a statistical anomaly. Today, the financial architecture has standardized the production of these entities. By keeping companies private for much longer periods than in previous decades, venture capital firms captured the explosive growth phase that was historically available to public market investors. The systemic result of this delayed public entry is a profound wealth concentration. The massive financial rewards of technological disruption are increasingly captured by a highly exclusive network of institutional investors, sovereign wealth funds, and early-stage venture capitalists. By the time a mature technology company finally executes an initial public offering, the most lucrative phase of wealth creation has already been locked away behind closed doors, inaccessible to the broader public. The geographic footprint of this capital concentration is equally stark. Silicon Valley morphed from a regional technology hub into the epicenter of global financial gravity. The influx of venture capital fundamentally reshaped the local economy, driving up real estate prices, displacing traditional industries, and creating a hyper-stratified society. This localized economic distortion is a direct reflection of the extreme power law distribution operating at the macroeconomic level. Furthermore, the relentless mandate for disruptive scale often generates massive negative externalities. When venture-backed companies enter traditional sectors like transportation, hospitality, or healthcare, their subsidized growth strategies frequently bypass established regulatory frameworks. The capital acts as a shield, allowing these entities to absorb massive legal and operational losses while they dismantle legacy industries. The ensuing regulatory clashes are not accidental. They are a calculated cost of doing business in the pursuit of absolute market dominance. This dynamic shatters the myth of a purely meritocratic free market. A startup's success is rarely determined solely by the superiority of its technology or the brilliance of its founders. It is heavily dictated by its access to deep pools of venture capital. The ability to out-fundraise competitors translates directly into the ability to outspend them on talent acquisition, marketing, and predatory pricing. The financial backing itself becomes the primary product. Once a venture firm achieves a high-profile exit, a powerful feedback loop is initiated. Institutional allocators, such as pension funds, university endowments, and family offices, rush to invest in the firm's subsequent funds. This concentration of capital allows the most successful venture capitalists to dictate terms, corner the most promising deals, and essentially anoint the next generation of market winners. The architecture of innovation becomes a self-reinforcing oligopoly. The decade following the 2008 financial crisis poured accelerant on this machinery. An era of unprecedented low interest rates drove institutional investors desperately searching for yield away from safe bonds and directly into the high-risk embrace of private equity and venture capital. This macroeconomic environment flooded the startup ecosystem with cheap money, artificially inflating valuations and extending the runway for companies with deeply flawed unit economics. In this capital-rich environment, the fundamental definition of corporate value became distorted. Profitability was actively discouraged if it came at the expense of user growth. Billions were incinerated subsidizing on-demand services, creating a temporary illusion of technological progress that was, in reality, merely a massive transfer of wealth from venture capitalists to urban consumers. The system was optimizing for the next funding round rather than sustainable enterprise viability. When the macroeconomic winds inevitably shifted and interest rates normalized, the underlying fragility of this subsidized ecosystem was exposed. Companies that had relied on endless injections of cheap capital to mask structural unprofitability faced a brutal reckoning. Valuations collapsed, funding dried up, and the ruthless efficiency of the power law reasserted itself, culling the herd of artificial unicorns and leaving only those with genuine structural advantages. This cyclical destruction reveals the ultimate truth about the venture capital matrix. The true product is not the software, the hardware, or the disruptive service. The true product is the equity itself. The entire apparatus is designed to manufacture financial instruments that can be rapidly appreciated and sold to the next tier of investors. Innovation is merely the necessary raw material required to fuel this financial assembly line. Despite its volatility and inherent ruthlessness, this financial architecture has become the inescapable blueprint for global technological advancement. Nations around the world now desperately attempt to replicate the Silicon Valley model, establishing sovereign venture funds and offering massive tax incentives to attract high-risk capital. They recognize that in the modern geopolitical arena, technological supremacy is inextricably linked to the ability to effectively deploy venture funding. The systemic impact of venture capital on innovation is profound and irreversible. It has accelerated the pace of technological change to breakneck speeds, but it has also dictated the terms of that change. It prioritizes the disruptive over the sustainable, the monopolistic over the competitive, and the exponential over the linear. By defining the parameters of what gets funded, this invisible financial architecture ultimately dictates the shape of the future we all must inhabit.